Hey, listeners, welcome back to the ValueHunt podcast. And today I'm truly excited to be here with Maj Soueidan. I hope that I pronounced that correctly, but if I didn't, I'm sorry. And yeah, Maj, why don't you say a couple of words before I ask you the hard questions and all that?
I'm ready. Hi, David. Thanks for doing this. I think we've been trying to hook up for a few months here, maybe 3 months or so, and we got lost in the email mix there. But I'm glad you were persistent and contacting me. I wanted to do it. Yeah. So I am Maj Soueidan. I'm a co-founder of Geo Investing, founder of a new Substack called MS Cliff Notes. We also like to call it the microcap investing Substack. And I've been a full time investor for over 30 years, maybe working on 4 decades soon, and really investing in smaller cap and nano cap companies. You can you can follow Geo at Geo Investing on Twitter. You can follow my Substack at Substack. We also have um, a, um, a handle. I think it's called MS Meyer Caps is the handle on Twitter, and my own Twitter handle is at Maj Geo Investing. And, this kind of happened since we last talked. We also just launched a new press release tool. People do research. That is a really exciting part of my journey here, and I'm about to launch. I don't know if this will be out when this recording will be out before March 3rd, but between March 3rd and March 7th, we're doing. I have this called Starting Five Virtuals, and we're going to do a virtual event with about 20 companies and 5 featured speakers. So we could talk about that too.
Yeah, that's pretty cool. Probably we could just also mention that you're number two on Microcap Club. I think
What?
you
It's been a crazy little hole there because I was it was you're two for a minute and then you're 20. So I'm glad we delayed the podcast so I could get that in. Thank you. I know Ian. I think Ian was. Ian, me, Paul were in that kind of mix for a little bit. Paul's been number one for a long time, I think.
Yeah. Actually, it's pretty interesting because a few months ago I interviewed Mike Diddy King, and man, like great guy, and also I guess on the top of that list, or at least on the top five, I guess. So yeah, it's pretty interesting to get to talk with people like you. So I'm excited for the interview, and probably we could start from the early years. Um, I don't know if the listeners know, but you used to work at Vanguard for a while. So probably you could, yeah, just
Right.
tell us how that experience was for you and what did you learn and yeah, how that went from that
Yeah.
experience.
By the way, Mike DD, he was number one for a long time with his. And what's really cool about that, what got him there, I think the symbol was PFHO. I think it was called Pacific Healthcare Organization, and they basically it's an OTC company, really a liquid. But I know he was buying it, around probably under $1 or $2. I know I was buying it around there too. And that stock went to like, yeah, I think it went to 60, $70. It was a huge move. Or I forget what the top was. It's split since then, so I'm just going off the pre-split numbers. But it tells you how that round trip can happen. All of us investors go through that. So because when you ask me like what I've learned over time, it leads right into that. I mean, Mike was number one for the longest time, and that stock reversed. So this you have these in microcap land, you have different levels of multi-bagger moves over time, and it's like and when I look back at my career, I see all these. Everybody wants that 10 bagger, 20 bagger, right? And we forget how powerful singles and doubles and triples can be too. But that's really the most challenging thing about it. As you're going for your 20 bagger, how do you stay the course? And if you're doing that, you got to be careful that you don't want your whole career to be defined by by only being in that tunnel vision, and then your career not being optimized because you're just looking for a top 20 bagger, and forgetting that there's a lot of money to be made in nano cap land at even 2 and 3 baggers, really. So just that's really, and it's really the falling in love aspect is the hardest part of investing I've had to deal with. Yeah, I know we're going around circles here a little bit, but I think it's important, really, and everybody I think has their own um, their weakness and strengths, right? And what's strong for you or weak for you will be different from me, and you got to understand who you are as an investor, so you can define your discipline, your buy and sell discipline around that. And that's what I'm always trying to do. From day one to now, I'm always refining that a little bit. And it's taken me years to, get to a point where I've changed. I'm starting to understand myself as an investor, a little more than day one. So like right now, for example, I think I'm about 30% maybe in cash or maybe a little more. I've never been in cash. I mean, when I was from day one investing, because I started with like $3,000, and I love investing in stocks. I like owning as many great companies as I can. For me, being a concentrated investor, like only owning 5 stocks, is too boring for me. And I want to have fun at what I do. So I like to own all these companies and learn about industries and stuff. So, but in order to do that, I had to use a lot of margin. So I was basically on margin, heavily margined all throughout my whole career, really. And it's just until recently, of course, I'm 54 years old now, so thinking about that a little bit. How many more round trips do I want to go through? And, and you start thinking, okay, well, maybe I'm going to be. And it's tough for me because I want to be investing in a lot of companies I see, but I'm keeping that dry powder. I want to be there for the next crash, where I can maybe go buy some big caps. Go buy Google and Amazon on sale, because I've never had that opportunity because I was always fully invested on those round trips. So I fight myself every day not to go that piggy bank, keep buying those wonderful stories I'm finding, because there's so many wonderful stories in nano cap land and small cap land. So I think if you look at my career from day one to where I am now, that's how I've changed the most, really. And when I started investing too, yes, I remember like how did I get exposed in the small cap world? And my first stock I bought wasn't it wasn't a micro cap. It was probably maybe a mid cap. Maybe even, I can't even remember. Polygram Records, I think it was. Acclaim Entertainment, which was a video game maker. They were all, I think, bigger cap companies. And my dad got me into investing, really, indirectly. I've talked about this before, and I love talking about it because it brings me great memories of my dad. He basically, I would watch him, just watching the NBR. The Nightly Business Report. Paul Kangas used to be the host of that show. Public Broadcasting System was where it was on, and I think it's still going on today. I don't know. And they used to have a segment there where he often would have maybe not a large cap company they're talking about, and then he would usually show the big mover list of the day, and then there was some small caps that I didn't recognize. So I started seeing this world of stocks beyond the big guys. And then my dad used to do a lot of research in the basement. I call it his stock cave, really. And once in a while, he would come up from the basement and, hey, I found the stock, Maj. I'm like, who is this stock? I never heard of that. And there was some small company. I went, well, where do you find these companies? And then he showed me like the Wall Street Journal. And that back then, because there was no internet, obviously, I'm going back now to like the mid to late 80s. And there was a section. I used to do a lot of momentum research, so tracking new highs is how I basically momentum plus value was my strategy early on. And I used to track new highs, and one by one, write them down. And I used to use the Wall Street Journal or the Barron's, which would track new highs for you in different sections. It would have a NASDAQ section, an MX section, and a New York Stock Exchange section. For some reason, I just never saw the over-the-counter section. And then my dad showed me that. He had this huge multi-bagger. I think it was called Numerex. The symbol was NMRX, which at that time was OTC. And the thing was like 5 or 10x or whatever. I was like, oh my God, what is this thing? I think they did like security software or security products, whatever. Eventually that round tripped over time and it became below a big cap company. But then I really fell in love with it. I was just looking at really cool little names. I didn't come from even though I was a finance major in college and stuff, I wasn't really a finance expert per se. I wasn't great at finance per se. You're not going to see me sitting here doing like spreadsheet analysis and making models. And I spent most of my time in college outside the class understanding the art of stock picking, because you weren't getting that in school. You were just getting basically like, you can't build a stock, portfolio past 12 stocks. You're never going to beat the market, blah, 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 all this stuff. Calculate the Sharpe ratio, all these little things, beta, whatever. And I just want to know what makes a good company. And can I buy it cheap? And do I have a relatively decent radar on them being successful? And that was what I really concentrated on. And I really wanted to understand businesses. I really wanted to understand how management speak and how they talk. Understand, how do I trust management teams versus the bullshit. I think that's a really important part of the business. And and a lot of that too, man, was because of where my weaknesses were. And my strengths aren't, being as math whiz. It's funny when you talk to somebody like, oh, hey, you must be great in math. Well, I'm okay in math. I'm not sitting here like Rain Man. When you go with freaking numbers. So I knew where I had to be stronger, because I know I'm never gonna win. Beat somebody who was really proficient in some of those really technical areas, or very in the studious areas, for example. So I knew I had to get an edge in some other fashion. Um, and that edge was really, to me, is understanding businesses from the qualitative point of view, understanding how to interact with management and how to really bring a story out from them the optimistic guys, the bullshit optimistic guys, the true ones. Are you telling the truth? What are the red flags? So building that kind of qualitative around it, and so I know enough about the quantitative to make a decision on stock is undervalued, overvalued, to know how to value companies and things like that. But I really want to understand, if you're gonna be this, look at this 5-10 baggers, you need to understand the models. But that was an evolution of learning for me to figure that out. So because I was so weak, though, in beginning in my career, in terms of just understanding businesses, I was very focused on short term. So this goes back to my days there. But by the way, what got me, the reason I love buying, owning a lot of stocks, is because I came from, my dad gave me the book Peter Lynch Went Up on Wall Street to read. That was my kind of what really got me into it. I mean, I was watching my dad invest for a few years. I watched him, be very, very calm during market corrections. And then he gave me the book to read. I think it was maybe 91 or 90. I forget the exact year he gave it to me. I read that book like 2 or 3 times really quickly, and that was it. I knew right there I wanted to be a full-time investor. But then Peter owned thousands of stocks, so that's why I became accustomed to doing that. But the thing is, so I was really, as a young kid, you want to make money fast. So at that time, early in my career, I just wanted to make as much money as I could really fast, grow the portfolio, and then think about the next stage of my strategy of building wealth over time. So I was really focused on short term. I had a short term vision at that time. So I asked myself, I'm going to make money short term. How am I going to do this? And being short term, though, also was at that time a symptom of me not being mature enough to understand what long term means and the value of investing long term and the value of understanding long term businesses. So basically, I did develop a strategy to try and understand when companies that I wanted to follow, and I was, by this time, let's go back, and now we're in 1992 probably. I graduated from college, and I'm working at Vanguard part time, full time. First full time, then part time, really, and then I getting a little more tools, access to tools here and there. So how can I basically find these pockets of growth in these small companies and ride that pocket of growth, and then say goodbye? So my strategy really was to enter a stock right before an explosion in their earnings per share growth, given certain valuation metrics as it was hitting. It was basically the Peter Lynch approach. I would say, if a stock had a PE of less than 15, on forward numbers and a PE of less than 25 on trailing, I would put it in my like undervalued bucket maybe, and then look at all the other stuff around it, balance sheet and other risk measures. And then I would try and say, okay, well, can this company have maybe a good 18 months run of in good earnings, quarter by quarter by quarter? And that's what I did. And that's the and I and go ahead.
No, yeah, I just wanted to kind of ask you, if you had to go back and know what you know now, where would you start, like learning about these microcaps and investing and all that? Because I guess you would have done it differently from what I understand. So yeah, please expand on that.
Well, then, you know what? I don't know. I'm glad. Well, let me put it this way. I'm glad I didn't do it differently because I don't think I would start any differently because I don't like sticking to stereotypes. I don't like saying only long term, only short term. I'm glad I got exposed to the short term strategy and it was successful because yeah, I don't have the audited results to show you, and just don't quote me on this or hold me to it. And, if you want to delete it, but you don't want to get into trouble. Of course, I'm not an investment advisor, all that good stuff. Um, but I was, on average, doubling my money on average for 20 years every year, doing the strategy of finding these pockets of growth and then leaving them behind. I didn't care. And you would have maybe this little run, and then as many small companies do, they go through ebbs and flows. Would I so if and why would I do anything else when that was working well for me? Okay. Um, but what I did realize, over time is, well, when I went back and studied things a little bit more, like a postmortem on how some of these stocks did, oh my God, I missed so many great. I mean, they were definitely a lot of round trips. I'm glad I sold them. But there were a lot that just went crazy. Midland, MIDD, Monster Beverage, of course. We probably all owned that at one time if you're my age. So many of these stocks. But of course, it's easier said than done because a lot of them were round trip also. So if I had to go back in time, I would have tried to say to myself, okay, well, instead of automatically just selling some of these stocks when their earnings per share growth was going to slow for a period of time, because I would try and get out a quarter before the slope here was going to happen. And I would use my, at that time I was leaning a lot on analyst estimates. And I want to come back to that too, by the way, David, analyst estimates in a second. There's a stereotype there too. Especially for young investors. For young investors, it was great for me to have these estimates. But I wish I would have said to myself, okay, like created this watch list bucket more actively to follow these stocks like more accurately, more closely, which ones failed, which one went on, and maybe why the ones that succeeded, and pay attention to them. But the good thing about what I was doing back then, it kept me very, very disciplined. Here was my strategy of looking at these pockets of growth opportunities. Once evaluation, one or two things happen. If I was going to basically be able to predict or foresee earnings per share growth slowing, I would sell it. Or if the valuation got ahead of outside my range, I would sell it. I wouldn't even ask questions. It was boom, boom, boom. I didn't even. It was great to have that kind of ability to do that. And the reason it worked, by the way, for that 20-year time frame, Dave, was because the market was good too for this. I mean, with the small caps were in, the chain wasn't broken. You had demand from retail investors. You had demand from institutional investors once the stock went over 5 or whatever number it had to go to for them to get in. So you had a very efficient kind of way of discovery, but you still had an edge in small cap world because you had less competition at certain market cap levels, right? So when 2008 came along, everything broke a little bit. You had the global recession. You lost a lot of investors. Retail investors left the door. Institutional investors didn't want anything to do with these things anymore. Fast forward today, you got regulatory issues making it harder to buy these stocks. But during this, really the first, of course, the 2000, the internet crash was a challenge. The bubble was a challenge, right? But 2 years later, everything's back. And when the internet bubble crashed, value investing came back pretty quickly after that. So it didn't wreck the internet bubble didn't wreck the Microcap space. It just was a tough period to be involved in. But when we had the '08 crash, that just wrecked. I mean, that just if you thought 2001 was bad with the internet crash, 2008 was just the magnitude of that, right? And I didn't see it coming. And no one's. I was up 20% before the day, 2 or 3 days before I lost 50% of my money. You know? Yeah, it's that you had this like cockiness. All right, this is gonna work out. And you hit with that. It's wild. Like, the internet crash was like a slow bleed for me, and then a slow, then a moderate recovery. This was like boom, right? And being on margin, you can imagine how stressful that was. And then being these liquid stocks, it was great. It's crazy.
Yeah, yeah, yeah.
Yeah.
Actually, I would like to jump in on that because I would like to ask you like how do you deal with these like emotional roller coaster type experiences, and how do you keep your emotional stability in check in those moments, especially like when you're in margin and all that. I guess, yeah, as you said, it just magnifies everything. So please, probably you could just talk about that a bit.
Sure, sure. And I'll come back to that. I want to come back to the environment itself. Yeah, and what happened in 2000, the change in the Microcap universe after '08. That's a very good point. I think again that's about knowing yourself. I just have this. I have an ability to turn it off, right? The last girl I was out with, she called me this. Calls an iceberg. When it comes to emotions, like I'm an iceberg. It doesn't bother me. I mean, I just know how to tune it out. I don't. I basically learned to like not watch CNBC anymore. Try and get away. I'm trying to get away from all negative stuff and just march forward. And one thing I did um, early on, after when the internet crash occurred, and at that time I started hiring. I hired one person who was basically an assistant of mine at that time, and I said, look, and he would do some trading for me. I said, I'm not looking at my portfolio. I'm not looking at the value of my portfolio anymore. I don't want to see it every day. Just tell me, how we're doing. I don't have to know. I just have to know, when we have a margin call. If we don't have a margin call, we'll fill it. Can we buy some stocks today? Are we generally up this month, this year? And I just don't want to see the day-to-day valuation, the change in the valuation. So I basically took myself away. I was just lucky enough to be able to do that. They made some good money. I could have somebody to do that and let them deal with all the stress. So I walk away from it. So I haven't watched CNBC since 2008-9 area. Basically, I slowly weaned off it. Uh, I don't really read much of the about the rhetoric out there. I mean, Twitter, sometimes you see it and you get sucked in here once in a while. But really, it's about being smart too. And like, if I don't know if there's a magic bullet, you can say, for example, everybody will say to them that, okay, I'll handle it. I'm going to buy great companies. I'm going to buy great stocks, and I'm going to hold them through everything. And then when that day hits, you're just everyone's jumping off bridges and jumping off buildings. And I get calls from people. Oh my God, what's going on? And after they were, I got this, and it's not easy. But my whole thing was one of the best things I did when I was younger. I do less of it now, but I didn't when things were going really bad. I would just like say, I'm resetting. I'm hitting the reset button, starting over, and just from a fresh slate. And that I don't do that as much anymore, but I think doing it will be better. It's because you have 10,000 stocks out there in North America. If you're gonna if having a clean slate makes you mentally ready to jump in again and build a portfolio again, because there's going to be a lot of junk in that portfolio. If you're a diversified guy like me, there's going to be the companies you can let go of, but don't be afraid to hit the reset button. I don't mean like hitting it every day. Like when you get to the point where you can't take anymore, right? Hit that reset button and start over again. That was something that was really good for me. And I never wouldn't look back and regret. But usually when you do that, you're resetting at a bottom. So it's usually calling the bottom. That's fine. But I've also written out stuff. I've done both, and it's worked out. Um, the key obviously is to be able. And then one other thing, from being a full time investor. So you say, how do you handle crisis? How do you handle emotion? It's not just what you do in the stock market; it's how you handle the rest of your life. So if I'm on margin, that's stressful. That can cause extra stress and make me make decisions I shouldn't make. Maybe panic sell when I shouldn't panic sell, or maybe force to panic sell. If you are in personal debt or in bad financial situation outside the stock market, your investing strategy should kind of accommodate that somewhat. Don't go on margin in the stock market. Just the stress in your life in general, especially from the financial stress outside the stock market, can still affect the way you do things in the market, right? So, but what I've found, David, is there's no magic bullet, man. There's no magic bullet. People want that magic bullet, and it's an evolving thing. What I will say is this: like if you are, there are some people who just can't be long term investors. It's just true. There's some that can't be short term investors. But the good news is you can make money on either pendulum there. You really can. And I'm torn between which one is better. I'm torn between because now let's bring back to '08 again. When '08 came along, my short term strategy wasn't working anymore. Because when you had when the liquidity the flow of funds to that universe was broken, you could find a great company, they could have great earnings, and nobody would fucking care because you had to reset the valuations coming down too. So now I'm sitting here exposed to a company potentially. Let's say I was right. I'm predicting they had 3-4 quarters of good stuff here going, and that happened. And now I'm sitting here making no money in this thing, and I have to hold it longer than I want to hold it, maybe, and which might be uncomfortable. I ended up having to basically start not looking at these pockets anymore. I mean, I would identify them still, but be prepared to invest longer term in companies. So I started taking a much more longer term view on analyzing companies and honing my ability to interview management teams. So I got exposure to that side of it too. So there's stress in holding a multi-bagger because there's no 110%. You're gonna go usually if you're gonna go from that 10 bagger or 20 bagger, there is going to be a challenge or obstacle to that company that's going to basically test your resolve. I mean, if you look if you look back, KRMD, which I still own some of it, the old symbol was REPR. That was one of my biggest multi-baggers I was able to hit. Right, it went from and 40 cents. Actually, I bought it originally around 10 cents. I think I wrote it up at the club around 40 cents. Got as high as I think it's 12. I held it for 13, 14, 15 years at that time. It was a crazy amount. And it was so, but the first multi-bagger move was like 8 cents to 40 cents. But I didn't own a lot of stock. It was one of those like I don't care position. So but then they hit some stock went to 70 cents, 80 cents. I was doing an interview on a radio show. I'm sorry, it was a radio show called The Everyday Investor. I was the host of that show. It was in Boca. And I had the CEO of that company interviewing them live on the radio. And they weren't paying. It wasn't a paid thing. I had to actually pay to be on the show to rent the airtime. And as we're talking, I'm getting my text message is blowing up. Like, oh, the stock's probably going up, right? So it's like crashing. So I'm like, what the frick is going on? So we end the conversation, and driving home, I call my trader up, and he said that KRMD just filed an 8K somewhere about having some FDA issues, FDA warning letter. I'm like, why did this guy come on the freaking show and do that to me? so now my first challenge, right? This guy's telling me all this great stuff. They're getting an FDA warning. I'm no expert in the FDA, so I now had to spend like months and weeks figuring out what this letter meant. Do I believe the company that's going to be okay? And that was the first challenge, and I held it, and it ended up going to where it went to. with Expel, which that's Paul Andrulio's big pick, and that's why he's number one right now in the club. Is if you held that stock, I had that at 20-30 cents. I sold it at probably I think it was $3, right around the time that they were hitting this, having problem. They got the lawsuit, I think, with 3M or something. You would have had to basically, and they did a great. I didn't go deep deep into past the lawsuit. I just maybe let's get rid of it. That was one of my resets, right? Reset. I don't care. Never came back to it, but that was an amazing multi-bagger run after that. How are you gonna? So I think that's really tough part as an investor is how do you understand these? Understand you're gonna meet this challenge if you're gonna go that 20-30 bagger and how you can deal with it. Now with Expel, I didn't care to do more deep research. I should have paid more attention to the club a little bit probably. But with REPR and KRMD, that was the new symbol. I did a lot of research on that to really dig into to see if that was going to be okay and work out. So that's something that's, I think, if you're going to go for that big bagger, mega bagger, that's going to be really tough. Not only holding through the challenges of a company, the market volatility, and think about this. Think about when you have this great multi-bagger setup. You think great growth going on, market pulls back, stock retraces. Now you got to ask yourself, by the time the market comes back from maybe a correction or bear market, is this company still going to be hitting on all cylinders where it can recapture the multi-bagger gain? All these things are going through your head, right? So, which is why I like a diversified approach to investing, because I don't have to mainly, if I can have a lot of exposure to great companies, this cycle by themselves, and I just let the best companies. That's one way I attack it. So that's a lot of information there, kind of to pack in there. But we are now at a fast forward today, David. I think it's 2022. We are finally back to a level where I think small cap value, nano cap value is the lead dog right now. You don't see it in the Russell 2000 index, but it's back. So basically, the environment I invested in my first 20 years is back again. People, you have money coming in when you had the 2020 reset and all the growth stocks get crushed. You have rates at normal levels. Quality matters again. So that everyone's chasing quality. So now we are back to that kind of. I'm so happy about it. So I'm humbled being able to survive and go through it. Now I have a combined strategy of short term plus long term stuff. So that's what it all comes. That's how the whole journey occurred. So I'm glad that I got exposed to the short term. I'm kind of glad I got exposed to the 08 recession and developed a long term strategy. Now I kind of combine it all together, and I'm having fun with it again.
I actually want to ask you a question on that because I started out as more like a Chris Mayer fan and like a coffee can approach and all that. And then kind of my mentors taught me the more like microcap way to investing. And it was pretty hard to kind of hold both strategies at the same time. It created a lot of like cognitive dissonance and all that because you were looking at different kind of stuff. So I'm wondering, how do you manage those different strategies? Does it help having a team? And like probably just expand on that. And also after I want to ask on the like position sizing and all that, because it might be interesting. So probably you could start with the strategies and all that.
Yeah, sure. I mean, I think to me it's I have a team, and a team definitely helps bring ideas closer and faster to me. Like Geo Investing Network is building that over years, has helped. The network brings ideas to us, which is great. I'm grateful for that. But I just love doing doing research. So I don't have really what I'm always trying to do is figure how do I bring my ideas faster to me? How do I take my manual process? And, so I have my staff. So now what I'm trying to do is really, you can use AI and stuff. I'm trying to figure out how to replicate my research process using AI to help me maybe even be better at that. So that's important. But managing strategy has never been a problem to me. What's really tough is managing time, just because I love doing the grunt work. I'm just used to doing the manual work.
Yeah.
For these years, and I know it just takes time, so that but we have different strategies to apply. So if you're asking me like, what's my favorite strategy? That's also tough too because it depends upon the market and what I'm seeing out there. But I think that what's really important though is to um, always take some time. Now you can like for me it was when I was younger and had a job. I would spend 4 or 5 hours on a Sunday going through all of my research and stuff, and that was all I was doing really. Now it's like, yeah, I mean, I'll just, I don't want to, and I don't want my research to be, I don't want to get burnout too. So I might do a week of everyday research, and then I'll take 3 or 4 days off.
Mm-hmm.
But I think that managing strategy hasn't really been too hard for me. I have a lot of different strategies I like to use. I mean, I like to make investing fun for me. So I'm a
Yeah.
momentum investor. I'm a contrarian investor sometimes. Sometimes I'm a catalyst investor. Sometimes I'm a short-term investor, long-term investor. And it really depends on this. I let the setup come to me like this. When I find a setup, I'm not out there. I'm going to look for a short-term idea. When I find each stock, I look at independently. Is a
Yeah.
stock telling me it's going to be short-term, long-term, both? Is it telling me it's going to be information arbitrage, which is probably my favorite strategy right now, is InfoArb. I know we talked about that a lot. A lot at Geo now, but it's only really available in the smaller cap space.
Yeah.
And to me, it's my favorite strategy. It doesn't take a lot of time, which is great for those who are time constrained, and it's a very systematic way of finding great opportunities. Um, but it's basically taking finding information in conference call transcripts and SEC filings that's not in press releases. That's really simple, really, and it's all day long in Cap land, all day. And
Yeah.
it's a great way for young investors to have success in investing because it's not really necessarily all about the numbers right away all the time. It's sometimes about the story. And
Yeah. Yeah.
I think you might have the numbers, but um, it's really exciting because you're playing on this misinformation that is going to eventually make its way out to the public market, or deeper. I mean, they're all public information, but in the broader market, and the price discovery is going to cause a stock to go up. And that's my favorite thing to do right now.
Makes sense. And so, how many kind of positions do you hold at a given time? Like, is it more like Peter Lynch style or like
It's
Charlie
more.
Munger?
I'm going more towards. I change over time. Like during when I first came, my highest ever I've ever had, my younger years was 400.
Wow, that's a
Um,
lot.
and then during the post '08 period, maybe it was like 20 positions I would probably stick in. I would have, and then 5 very concentrated positions. So I was a very concentrated investor. Now I'm going back to really building this probably 50 to 100 names kind of direction.
Mm.
I built through the Substack, we built this index. It's called the Quality Index. And these are all stocks I would want to own if I had the money to own them all. And it's basically, there's 108 stocks in the index right now. And they're all based on the way I used to invest in 2000. I mean, early in my career, the short term kind of catalysts. Basically, I'm looking for these quality companies. We made a list of quality companies. When they're hitting multi-bagger markers, they go into the index. So but my multi-bagger markers are much more expanded than they were when I first started. So those are the stocks I'm really hunting in right now, and those are the stocks that populate geo investing too. Yeah.
That's interesting. So,
Yeah.
what are like multi-bagger markers?
So let's go a few of them. So basically, there's about eight I look at right now, 8 of them.
Mm-hmm.
But let's take a look at some simple ones. Are finding a company. One of my best multi-bagger markers is this. Setups is this because I want to combine a multi-bagger marker with the unobvious. So where are people going to miss this multi-bagger because they're not looking at it? So one of my favorite setups is my I call them screens, whatever. I'm not actively screening all the time, but what I'm looking for is these stocks where they're not growing revenue, and they're restructuring a little bit. They're real companies, great companies that have already a presence in the market. have had been around for a long time, but are hitting multi-bagger markers that screens are missing, because if the revenue is not increasing, a lot of people are not going to look at that. All your growth investors, bye-bye. They're not looking at it.
Mm-hmm.
So trying to find these early stocks that look really boring on the revenue line, but you're starting to see some things are going to happen to basically affect the net income line. So operating leverage, I'm looking for companies that can maybe grow maybe 1 or 2% and get a great increase in their earnings per share, net
Right.
income. When they hit it, and then I want to, and then when they had 10% revenue growth, oh, watch out, right? This thing can go crazy. So I'm looking for these companies that are restructuring their. So a lot of times you'll see is this: you'll see these bad sales comps of some of these companies, but you got to read deeper than just a number. Well, why is that? Always ask why. And it could be, okay, well, maybe they sold a division that didn't have high margins.
Yeah.
Yeah, these kind of things. So I just found one of those today, actually, or yesterday, today. And
Probably we
then
can talk about it later.
it was pretty illiquid. I don't know. We'll see. But I give it a great case. KEQU is a great case study. I own that one. Keanu Scientific, KEQU.
Okay.
Leader they make scientific lab equipment. Leader in the industry. Went through a management change. I'm not going to go through the issues in the past, but the last 18 months or maybe 2 years, the stock has gone from $12 to it's $70, I think, a couple of days ago. It's pulling back now because of some Trump bullshit, but it's an opportunity, I think. So with that was a situation where what did they do? They basically they stopped selling products in a division that was low margin. That was a piece of it. And then they did other things around that to improve margins. You weren't going to see the effect of that right away. So you had this first multi-bagger move when the value investors got in because it was all EPS driven.
Yeah.
That's what you've seen now. You've seen this move from $12 to it's all value guys getting in. The next leg of growth now that they've gotten right size the company, their margins are intact. Now they're making acquisitions, and now you guys are seeing revenue increase. Now the next level of growth. Now you're going to have the P. So the PE then was like when you normalize the PE for what was coming, it was like a 5 PE, and this is going to be a 20 PE stock one day. So that's like that's the multi-bagger. That's how you get your 10 baggers, 20 baggers. But so I'm looking for those kind of that's one side. So look at these really mundane, low growth companies that aren't screening well, where you know a multi-bagger change is coming. So that was operating leverage. So that's a huge multi-bagger market where you can that's obvious. You can predict earnings growing faster than revenue. That's going to be operating leverage. One of the things I love right now because it is finding industry if the industry the company is in is changing, that's going to luckily provide them with a multi-bagger opportunity. And that happens in a lot of these old school companies that have been around for a long time, that where technology is changing, where they have now a new way of selling things to their customers, maybe cheaper or new products they can do to them. So, the reason I like this is because like the AI is a very controversial place. Will value investors invest in AI companies, right? And, you'll hear the Buffetts of the world. Oh, we don't invest in this stuff. It's this AI's growth. It's all hype. Well, a lot of it is hype.
Yeah.
But if I can get value investors, not even looking over here, that's even fucking better. Because I'm already in the minor cap universe where no one's looking at stuff. If I can get my own colleagues to say, "Oh, I don't want to look at this crap because it's all hype AI stuff," that's even better. Right?
Yeah.
So
Actually, that reminds me of now Vertical. Actually, I'm long, so like full disclosure, and next week I'll interview like the CEO and all that. So that's like a perfect example of what you just said, like AI play, turnaround, and all that, and like value investing type multiples. So yeah, it's pretty interesting how that can happen even in a bubble like AI bubble and all that. So
yeah, and it could be luck too. I mean, these companies, it's just dumb luck. I mean, you invest these great companies. Luck is great for them because they're already in good position. You could take a look at TSSI, one of the stocks I owned for a long time, and still own some of it, which went from 60 cents this year over the last year, 30 cents to hit $18 recently. They may integrate racks, AI racks, or data center racks.
Yeah.
So they put the servers together, the wire together, and then Dell's their biggest customer. Well, they were running. I mean, I own that stock since 2017, 18. And when I first owned it, it went from 30 cents pretty quick to almost $2. And then guess what? This goes back to we talked about earlier. It round tripped all back to 30 cents because they had COVID. The COVID exposed some weaknesses in the company, supply chain issues, inability to scale issues. New CEO comes in and fixed the problems. And now the new CEO came like 3 years ago and fixed it. But if AI didn't come along, because the new AI servers and racks that had to be designed were much more different than the old ones, and they just were lucky to be able. That the new CEO came in and made these guys the best integrators out there. But if that hadn't happened, I don't know what would happen to that investment. But that was an industry trend. AI offer opportunity for this company that was able to get involved in. Another stock I own, PSIX. Just got to the NASDAQ. This is an engine company that basically decided to make a enclosure to protect generators going into data centers. Now, it was not easy to find that information. So that was the industry transforming, or offering opportunity for a company to transform itself. And that stock has gone from $2 to, I think it recently hit $45. So that's just and it's a PE re-rate the whole time. It's what's great is you have this situation, low revenue growth potentially.
Yeah.
Everybody hates the company because they haven't performed for years, so it has a low PE potentially. Value trap. Value investors want to ignore it. Growth guys want to ignore it. So all day long. It's just it's your little party. This is it there. I can go on and on these things on the InfoArb, but another one would be they're all very one of my favorites, and you'll see me hunt on David. There's 10,000 stocks in North America. 20,000, 10,000 nanocaps, US, Canada. I like hunting in this pocket of companies that have been around for a long time. Okay. Because they have a customer base already and they've been through market environments. One of my favorite multi-bagger markers is these companies that just find ways to get more revenue from their current customers. And how can they get deeper into that value chain? What does that do? Not only does it create more revenue from your customers who already like you, but it also creates more predictable longer-term streams. The deeper you get in, you can get in earlier into a procurement process. Maybe you were selling products. Now you want to be part of the designing piece of it too. Maybe at the end of that, okay, well you install something. Now you want to do maintenance. You're seeing a lot of that right now. So you're seeing a lot of these industrial companies get because everyone knows the investor these days is shorter term in nature. The investor these days, their time horizon is 6 months. Used to be 6 years ago. So that's what investors want. Companies are trying to find ways to make their business more predictable and have this more, predictable earnings stream too. So you do that by getting involved earlier, selling more service to your customers that already trust you, and getting involved in the value chain at the end. So when you're looking to the industrial companies, you see a lot of that happening there. Especially a lot of these construction companies, infrastructure companies, that they're not just building anymore. They're getting involved in design, build, maintain. So that's recurring revenue is a big multi-bagger market. So when you see these companies transforming, everyone thinks that recurring revenue is software companies, right?
Yeah.
If companies can find any ways to make their revenue recurring or revenue stickier, that's a huge multi-bagger marker. And what's cool about that is a lot of times you'll be able to see those plans happening before the results come out. Because usually it's smaller revenue. A lot of times it's smaller revenue, upfront revenue. So if you can get in earlier than others can, if you believe in that business plan of that company. So those are some of my favorites right there. Obviously, restructuring of balance sheets, capital structure is a really favorite one of mine. You take a company with a lot of debt, that finds ways to reduce debt, obviously, or refinance the debt at better terms is really kind of cool. Yeah. So that's something right there I like a lot.
Nice, nice. Yeah, I see a lot of interesting stuff there. I must rewatch this interview afterwards because I have to take some notes. Um, but I would actually like to ask you a follow up on a question that was like on a thing you said on another interview. You basically said that in the early days, when you are like a private investor and you rely on capital gains for like making a living, basically, you have to strike a balance between being long term and actually having short term results, because obviously, yeah, you rely on that. So I'm curious to know, like, if you could expand on how you deal with that dilemma. And also I have a follow up afterwards on like tax and all that, but probably this part is more fun, so you can start by that.
Are you talking to about like the tax consequence of that? Or are you talking about like when to?
No, I was actually, first of all, I would like to know how you manage like being like having a long term mindset with actually having to hit pretty nice returns short term. Obviously, IRR is a function of like yeah, the growth in the stock price and the time. So
Sure.
yeah, probably just a part of like the psychological part of it, of managing the like the long term and being like short term driven in the sense that you want high returns or
Okay.
higher
I'm getting you.
IRRs.
Yeah,
Yeah,
I think a lot of too is I think what you're talking about when I was maybe talking about that, it was really the dilemma of being a full time investor too. So I'm
yeah,
a
exactly.
full time investor. I need to live off my income. So the
Mm,
dilemma of waiting for your 20 baggers, and then having your short term stuff going on too.
exactly.
Which is kind of why when I started off investing, I was more short term too, because I had to live off my investments. I think, the really kind of the way to approach this really is you have to realize. I mean, like if I was going to go back in time now, like and think about this, like in the perfect world, like after you ask that question,
Yeah, yeah, yeah.
I would have said, okay, this amount of my portfolio is going to be long term, and this part maybe will be a little short term. And I'll try some short term strategies. Now that I've kind of gone along that, now I'll fast forward now, 30, 40 years, I can do that now. I can say to myself, I know exactly what short term strategies are going to work. So it would be like my short term strategies to survive as a full time investor would be pretty much concentrated on two strategies. It would be info arb, which we talked about, finding these pockets of disinformation and making money on the misinformation. That having a time, taking advantage of the time arbitrage it takes for the market to find what you found. That's obviously going to go up.
Yeah.
You're basically this info arb where you're 90% sure it's going to go up because of what you found, and you can find us all day long in the stock market in nano cap land. Number one. My number two kind of short term strategy around my long term strategy is to buy we call it the buy and pullback, or the BOP strategy
Mm-hmm.
at geo
Mm-hmm.
investing. And we have model portfolios around that. We just closed our 12th one today actually. 12 out of 11 have been up. And there's design. My mindset in those situations is I have a holding period between 3 and 12 months for these stocks. So I create these model portfolios of stocks that are falling for the wrong reasons, and then I want to basically buy them and then experience hopefully they go up when the market figures out they were wrong what they did. So and a
Mm-hmm.
lot of times that happens around the best time to do a little bit of that is around earnings time, because earnings season you're going to get a lot of stocks selling off on misunderstood earnings reports, misinformation between press releases and conference call transcripts. You jump on those all day long. So that's how I would do it now today. And
Mm-hmm.
what's cool about younger investors they have the opportunity to do it because you have conference call transcripts, so you can alpha, you can get press releases, we have a tool now if you want to check it out. That brings up all press releases into one platform, and start just comparing things.
Makes
That's how I
sense.
would do
Yeah.
the short term stuff, and then of course along that I'm building my long term portfolio. And the cool thing about this too is like when I build a diversified portfolio, that I'm letting stuff marinate. When 5 years comes along, okay, now I'm going to have short term potentially income coming in sales. So my long term portfolio eventually becomes a short term income stream for me. as these
Hmm.
stocks start my long term marinates and starts trailing off and starts making some money for me, and I got to sell some. And of course, you
Makes
got to sell your
sense.
losers once in a while too, which creates liquidity and money.
Yeah, yeah. So like now you could probably also talk about the tax part of it, because I don't see many investors talking about it. Maybe because it's boring, but I guess that not a lot of people take that into account when starting like microcap investing. They do well, and then they kind of not they don't save for like the when tax comes and all that. So
Yeah.
probably you could talk about the risks there and how you managed it throughout your career.
Well, number one is move to Puerto Rico because you have to pay. You have to pay. If you're here 6 months in a day, they had the Act 60, so you can consider that. I mean, if I was, I mean, I don't know when the Act came in. I wish I would have came in the Act earlier than I did. Um,
Hmm.
that was late, but if that's something you want to do. But yeah, so I think that what I didn't do well was that piece of it, David. So I mean, I sometimes like I will talk about things that should be done, or maybe you're taking it that way, but it doesn't mean I did them all the right way.
Yeah, yeah.
I would never tell people they should be on margin, but they go on margin. But even though I went on margin to some degree, but this I think I've talked about. If I had to go back in time, what would I do? So when I started investing, I wanted to get rich in the stock market, build wealth through real estate. That was my kind of my mantra. So so that the bucket was okay. Create a real estate bucket
Hmm.
along with so when I sell stock, take maybe 20-30% of those proceeds and start building this real estate kind of fund, which I can start buying real estate with. What I wish I would have done when I was younger also was add several more buckets to that. And like you said, so if I'm making money, assuming I'm making money,
Yeah.
and I'm just setting aside these different buckets. So the real estate bucket would be for me, maybe put 20% aside for taxes. Just have it sitting there. Uh, Another X amount of money for the rainy day, just to have it for an emergency, and one more bucket for when the market crashes to have money there. And however you want to,
Hmm.
work it out. Now, the thing is, you may be giving up short-term returns and opportunity because you're sitting there in cash, but you're always going to have an opportunity. The crash bucket's always going to be activated at some point, right?
Yeah.
And just 15% of your money in the crash bucket, if you can, and when you have crashes, you can quadruple that money. It's worth it. You make up for what you might have lost, that used the sacrifice that you had to make, not to always
Hmm.
be investing at all. So that is the maturity I didn't have when I was younger, and the way I wish
Yeah.
I would have had to do that. But I will tell you, the real estate bucket saved my freaking ass during the recession. Oh wait, because I was disciplined in doing that, building real estate assets. And then when my portfolio got decimated, I was able to unload real estate. I mean, I bought good real estate too, mainly residential stuff. Um, I was able to sell off those assets to help me really, not just survive, but keep my staff going and everything, and keep
Hmm.
this going along with my personal life.
Makes sense. And so I guess that real estate it's more like a the safe part of your portfolio, even though you run margin and all that. Like I guess it was like an insurance for you in some way.
Yeah, well,
So
I
you
made
could.
real estate for a long way too, though, Dave. Right? So I was buying the real estate in cash, right? And
Hmm.
then I decided, I got a little cocky, making all this money in the stock market. I started, getting, a little bit of leverage in the real estate too. So, like today I don't have as much real. I'm getting back into my real. I'm starting to build it up again today. Like I don't have much today, but I was building a pretty big empire. I know. I was talking to my accountant, who used to be my accountant at the time, and
Yeah.
he would start buying, piggybacking off me, and he would see where I was buying. He would go buy some properties there. He still has them, like 15 years later. And oh god, the money, the rent he was collecting, I was making a good 12-13% on some of these properties, on really good
Hmm.
properties, and they've all gone up in value too. It would have been pretty amazing. We don't want to live in regret though.
Yeah, yeah, yeah. Obviously,
The
makes
point is,
sense.
it saved my butt. Having at least one of those three buckets activated and I did right, and it was really good for me. I can only imagine if I was doing much more mature to not think like a little kid.
Uh-huh.
I want all this money now. I want to go party and do all this, spending all this money. Yeah, I did a little bit of that. you know, enjoyed my time on the fun. I don't regret that, but I could have had a little more balance.
Got it. Got it. So, yeah, just to wrap up, I have three really simple but deep questions, and I would like you to answer them in the most concise way you can, I guess. So, the first one is actually, if you had to distill your success in three words, what would they be?
Yeah, okay, that's good. Well, hard work for sure. Hard work. No regrets. Being able to shield regret, and really um, managing my emotions properly during
Mm-hmm.
hard times.
Nice. Cool. Okay. So, second question is, what's the utility of money for you? I guess Morgan Housel did a lot of work on that, but would like to know your take.
Really, good question, right? Well, what is
I
it?
mean, you already have I guess you already have a pretty comfortable financial position. So,
Yeah,
yeah.
I think uh, for me, utility money wasn't get rich to get rich, get wealth to wealth. It was really just to be comfortable. It's really
Mm-hmm.
what it was. And if you want to really be truthful about it, I wanted to be comfortable. We get to a point where I can start really doing good things with my money, whether it was charity, um, going back to my culture and roots, and helping some of the less privileged there. I'm heading want to do that. And 2008 kind of hurt that goal of mine a little bit,
Mm-hmm.
but we built that up again, and now I'm ready to kind of embark on that new journey. It's like I want to really, make it work for other people.
Yeah. Okay. So, guess that's a pretty good answer. And yeah, my last question is actually what you like to do outside of investing. I do know you like to play the guitar and all that, but probably, yeah, anything else that you like to do.
Yeah, I love my guitar. I love playing tennis.
Mm.
Love watching football. I love playing football, but I can't do it anymore because of my knee. I've taken up pickleball now. That's been a lot of fun. I love hanging out at small little cafes and little bars of music with some friends. Not a big clubber. Don't like doing that at all. Reading to me is I love reading. I just love working. So I right now what I'm doing a lot of my off time is listening to a lot more podcasts than I ever have,
Mm.
and trying to
Yeah.
relate the podcast to my everyday life and how it's. I'm not really working, but I am trying to see. Okay, does that podcast open up a door for me to find an opportunity in my real in investing?
Got
I
it.
prefer podcasts more than I do reading. Just to admit that. Um, I'm not a readaholic. I enjoy it
Hmm.
to a point, but it's not my strong suit.
Yeah, yeah.
Yeah.
Nice. So yeah, I guess
I'm a
we
very
got a
simple guy,
pretty
man. Very simple.
yeah.
If I travel, I'm traveling to eat the food, play some sports, and just and work. So,
Nice, nice. That's cool. That's cool. I guess we got a pretty decent picture of, yeah, how you got to where you are today and what you like to do and all that. So, with that, I think I would just like to thank you for this wonderful conversation, and I'll make sure to add every link that I can find on you on the description, so can people can find you and all that. So, yeah, just wanted to thank you and hope we can keep this conversation going for the long term. So, yeah.
that sounds a great deal. I really love one day to really show you, maybe have more of a discussion on information arbitrage.
Yeah, sure.
We could do a show on that one time. I think it's really important for young investors. If you have young investors watching your show, even for all
Hmm.
investors, all walks of life. And would love to go over that press release product with you to show you how I think transformational
Nice.
it is for all of us. So cool.
Sure. Perfect.
All
So,
right.
yeah, thank you so much. And yeah, see you next time.
Thanks, David.